Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The power of tax-driven savings. We shouldn't underestimate how tax policy shapes our financial future. The union budget should reflect this. Even though the shift to the simple new tax system seems to be a done deal, the impact on the individual saver can be seen in two very different ways. Either lamenting the weakened savings incentives while acknowledging increased choice, or celebrating higher take-home pay while downplaying the impact on saving behavior. Both are wrong. They both miss the crucial point. Tax incentives for savings aren't just about immediate financial benefits. They're about creating lasting behavioral change. Consider what really drives people to start investing. Despite living in a world where consumption is constantly pushed at us through advertising and social pressure, tax-saving investment schemes have served as a powerful counterforce. This is particularly true for retirement savings, where the National Pension System, the NPS, offers superior returns and flexibility compared to the EPF, that's the Employee Provident Fund. The upcoming budget should expand options for employees to shift a larger portion of their retirement savings from EPF to NPS, allowing more Indians to benefit from market-linked returns and professional fund management. The psychology behind tax-saving investments as gateway products is fascinating. For many young professionals, their first real investment decision comes when a colleague or tax advisor points out how much they could save in taxes through ELSS. This initial motivation is purely tactical. It's about paying less tax, not about becoming an investor. The lock-in period, which often feels like a drawback at first, is crucial in developing investment maturity. During these years, something remarkable happens. Unlike short-term investments, where people obsessively check prices and panic at every market dip, the lock-in period forces a hands-off approach. This mandatory patience allows investors to experience the natural rhythm of equity markets. They see how initial volatility smoothens out over time. Through direct experience rather than abstract advice, they learn that time in the market matters more than timing the market. What's particularly powerful about such gateway investments is how they normalize equity exposure. Many young people start with deep skepticism about the stock market, viewing it as gambling. However, when they see their tax-saving investments grow steadily over time, it challenges these preconceptions. The mental transition from "I'm doing this for tax savings" to "I'm building wealth" is subtle but profound. This shift often triggers a cascade of positive financial behaviors. Having experienced the benefits of disciplined investing through tax-saving instruments, many people have started exploring regular SIPs other than mutual funds. They begin to understand concepts like asset allocation and risk diversification not as theoretical ideas but as practical tools. The confidence gained from successfully navigating their first equity investment often leads them to seek more financial knowledge. The psychological shift from spender to saver has benefits far beyond the financial realm. Adequate savings provide peace of mind that positively impacts career choices, relationships, and overall life satisfaction. It's one of the most reliable buffers against future hardship, particularly with retirement savings. Some argue that financial freedom means letting people decide how to use their money without tax-based nudges. While personal autonomy is important, this overlooks human psychology and the overwhelming pressures to consume rather than save. The tax rules savings incentives have been a rare institutional force pushing in the opposite direction, helping convert non-savers into lifelong investors. The beauty of tax-saving schemes is that they work with human nature rather than against it. They use our natural desire to save money on taxes as a hook, but then leverage behavioral principles like commitment devices, the lock-in period, and status quo bias. Once you start investing, it feels natural to continue, to create lasting positive habits. The initial tax benefit acts as a catalyst, but the real value comes from the long-term behavioral change it initiates. Drawing on nearly 30 years of observing people's financial journeys, I am convinced that tax-incentivized saving is one of the most valuable services our government provides citizens. However, as the new system reduces or even eliminates These incentives, while simultaneously maintaining rigid structures like mandatory EPF contributions, instead of allowing greater NPS flexibility, we may underestimate the long term consequences for financial security and well being. Time will tell, but I fear we are weakening powerful tools for promoting prudent financial habits.